Hello, folks. Welcome to this episode of Rich Insights. I'm Don Rich. Today's topic is on the secrets to value investing, right? I get the question all the time. Is value investing dead? Why has value underperformed by so much? Was Warren Buffett wrong? Were Benjamin Graham and David Dodd wrong to talk about value investing? I think the answer is no, right? Value investing is still alive and well, but it's changed, right? It's like when the NBA introduced the three-point shot. We're still playing basketball, but the game changed dramatically. That's what I want to talk to you about today. So value investing has underperformed by quite a bit. We're just going to take a look at that in a second. Let's jump right to the charts, in fact. So, again, this is the S&P 500 value versus growth. So essentially what happens is we take the S&P 500, which has 505 stocks in it today, I believe. And we essentially just cut it in half, right? So that would be 252 that we would label as value based on some valuation metric, and 252, would become growth stocks, right? That's not exactly how they do it, but that's close enough. Okay, so normally I'm a big fan of passive investing, as the regular listeners will know. So if you're thinking about trading the S&P 500, you might want to think about like the SPY, right? The SPY is a passive, cap-weighted ETF, right? So the SPY is for the overall index. SPY V is for value, and SPY G is for growth. And all three of these, SPY V, SPY G, they're ridiculously cheap to trade. The expense ratios are below 4 basis points, I believe, on all of them, right? Just ridiculously cheap. So this chart I'm going to show you is a chart that you can think about, easily reproducing. So we have the S&P Passive Value Index, all right? Something like the SPYV here is the blue line. And notice I've set these up to be indexed to 1 at January 1st, 2009. All right, so value has grown up here, right? And growth, right? Growth is just off the charts, right? Getting close to twice the level. Growth just had tremendous outperformance, right? And also notice, since the coronavirus lows, growth is up about 60%, value's up about 40%. Growth hasn't even been able to recap its previous high, its pre-virus high, where of course growth is long past that. All right, so that's the question you get all the time is why is this? Shouldn't we expect value to start reasserting itself at some point going forward? And I think, probably on a tactical trade, that's not a bad idea. All right. Tech is growth has run so far, so fast. That's probably not a bad idea as a tactical trade. What I want to talk about today, though, is more of a strategic trade. Just value investors all the time. Again, not for the next 2 weeks or 2 months, but I'm talking about, again, as a persistent tilt. Okay, to do that, let's talk about value investing and why it's different today. What has changed about it today? I have 5 considerations here. You see, number one is tech underweight. So if we worry about what value is today, right? What the 250 stocks are that are considered value today, we want to look at the composition. And the first thing that pops out at me is what's not in there. What's not in there? And that's tech. We're going through a digital super cycle and we're underweight tech? Shit. Does that make sense to you? Let's wind the clock back 50, 60 years. You want to go through the industrial super cycle and be underweight industrials? Well, now we're going through a tech super cycle. You want to be underweight tech? That doesn't make any sense to me. So I don't have any problem with people having a value tilt, but at the same time, let's think about this, right? Make sure that cornbread's cooked all the way in the middle there. We don't want any softness between the ears, all right? So the big problem you got to keep in mind, if you really just can't do a passive value index right now because there's too many holes to it, and the biggest hole is the fact that tech's not there. What else we got? Brick and mortar retail, all right? Tech's not there. All right. So the digital super cycle, the biggest benefactor is not there. But what is? The biggest losers, the brick and mortars, the going out of business, going away companies are in the value index today. That's another reason why it's underperforming. It doesn't have any of the good stuff and it's got all the shit in it. Wow, can't have that, right? That's going to be a problem. What else? Financials. Financials are overweight. I don't have a problem with the financial sector. It's just there's a cyclical problem, right? The digital super cycle we're talking about, that's a secular or a structural shift, right? A long-term shift. Financials are a cyclical shift. What do I mean by that? Well, think about it. How do banks make money? They take in deposits. They loan out mortgages, right? And with interest rates being so low and with the yield curve being so flat, they're not doing anything wrong. It's just that the environment is not conducive for them to make any money. So I don't want, if I'm a value investor, I'm going to say, man, I like value, but not financial value at this point in the cycle. Okay, so what else? Energy names. There's also a lot of energy names in there. Now again, that you got to think about that here, right? We've got this green effort going on. This green effort, right? The green initiative. Everything is green. I don't think of energy as a strategic investment. I think for the next 10 plus years, you can't think of energy as strategic investment. Tactical only, because this green push is not going away. We're going to keep becoming more and more energy efficient, in my estimation. So I don't like the energy firms that are in the value either. I kind of like them as a tactical play. Actually, they've been so beat up. But in general, I don't like the energy ones in there. What do I like in terms of value? Well, consumer discretionary and industrials, any value names you can find in there. I think those are very attractive right now. So let's try pulling everything together here. What are some of the secrets that I claim to be espousing here? Well, you just can't buy a passive basket like you could in the past. It's just not a brain dead exercise anymore. It doesn't mean that there's anything wrong with passive investing. It's just you got to become a little smarter about it. All right. And you have to maintain your structural winners, right? What are we talking about? Tech. Don't underweight tech, right? You can overweight value, but don't underweight tech. Find other areas to underweight because it's part of the structural, or the biggest benefactor of the structural secular shift that we're talking about here. Now, along with that, you want to keep your winners and avoid your losers. What are you talking about here? From a secular perspective, of course, the old brick and mortars are going away. Keep your tech weight, lose your brick and mortar retail weight, right? That's going to free up some space to give you the overall value weight, just not in this area. Avoid the cyclical losers. Again, I define financials right now as being a cyclical loser in the value space. And look to industrials and consumer discretionary when you're using your value metrics. Those are value stocks that I find particularly interesting. Okay, so that's our message for today. If you found it useful, hey, help a fat guy out here, okay? We got to keep the lights on. Please subscribe to my YouTube channel. It's called Rich Insights. Or follow me on LinkedIn. I have a bunch of posts on LinkedIn. We call it Fat Stackonomics. Become a fat stacker with me. All right? So I'm Don Rich, and you just experienced a Rich Insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.